You have a lump sum sitting in your account. Maybe it's a retention bonus, a house sale, or shares that just vested. The money isn't making you feel wealthy, it's making you feel anxious. You know inflation is eating it away, but you can't seem to decide what to do with it. You have options, but every option feels like it could be the wrong one, and that paralysis is rational. Most advice tells you just to dump it in the market, but that ignores the reality of your life. You aren't just investing for 30 years away. You're trying to solve for the next year's tax bill, a house move in 5 years, and retirement all at once. Here's what I know. You don't need more information. You probably already watched the 5 videos on how to invest a lump sum. You need a decision architecture. In this video, I'm going to give you one framework to decide your money's job and allocation, one pathway to sequence your money across the right tax accounts, and the final nudge you need to actually pull the trigger. I'm Qin, an ex-FTSE 250 leader and the author of The Compound. Let's build your plan. When we sold our first house, I had a lump sum in the bank and no idea what to do with it. Doing nothing wasn't an option. Inflation was eating it away. But doing something felt dangerous. My parents preferred safe, conservative options, and as an immigrant to the UK, I had no playbook. Here was the contradiction. I worked in fintech and knew the basics. I wasn't struggling with debt. But I also wasn't wealthy enough for a private banker. I was stuck in the middle. The online resources were too shallow or too scattered, built for clicks, not clarity. Nothing felt like enough. Nothing felt safe. Market crashing? Too scary. All-time highs? Too expensive. No moment felt right. So I did something fairly extreme. I joined a wealth tech startup as a founding team member. That is when it finally clicked. The logic of compounding, the levers of freedom. But even with the expert guidance, it still took me 3 years to build a coherent framework, 3 years of research, backtesting, and iteration. And as I started applying the system in my coaching, I realized something critical. It didn't just simplify my decisions. It brought clarity to everyone I worked with. The struggle was universal. I wasn't alone. The knowledge itself isn't the hard part. It is abundant. So why was it so hard to figure out and even harder to execute? The answer is simple. What you're experiencing is structural complexity. You haven't failed to understand the math. You've just been handed a broken map. The complexity comes from 3 specific places. First, time horizons colliding. You aren't answering one question. You are balancing 3 timelines at once. Near term, if something goes wrong, can I cope without touching this? Medium term, will I need this for housing or flexibility in 3 to 5 years? Long term, if I lock this into a pension now, what if I want to dial back before 57? Then the tax trap shows up. Do I use my ISA allowances now or save it for RSU vesting? Does the pension contribution keep me under the childcare cliff? Every piece of advice treats these as separate problems, but for you, they're one big knot. Second, money in transition. You earn well, which opens up options, but not quite enough to fund all of them. House deposits, holidays and hobbies, school fees, career flexibility. Too many competing goals for your surplus. The trade-offs feel heavy without a clear framework. Third, fragmented advice by design. You have fallen into what is called the UK's invisible advice gap. There are around 12.3 million people in this country with high incomes and meaningful savings, but no real guidance. We are too far along for basic start saving tips, but we're unwealthy enough to justify a private bank, with 6-figure minimum investments and fees that make us uncomfortable. So with nowhere else to go, we turn to the internet. And this is where the fragmentation hits. Most online advice is built to answer hot, searchable questions. ISA or pension, property or stocks, invest now or wait. Google is built to answer isolated questions. It solves one decision at a time, optimized for clicks, not coherence. So you end up with ISA guides that ignore pensions, pension calculators that ignore housing, and mortgage spreadsheets that ignore compounding. But real life arrives as a lump sum, plus a tax bill, plus school fees, plus a career pivot, all at once. Here is a root cause. Money decisions at your level are genuinely complex. And right now, you're trying to solve that complexity with zero support and fragmented tools. But here's what makes it worse. Even when smart people finally get access to knowledge, guidance, and frameworks, they still make expensive mistakes. Not because they're incompetent, being high-achieving often works against you in financial decisions. Here are 4 traps that specifically catch capable people. 1. The income illusion. Because income is high, everything feels fine, and nothing feels urgent. But without security built-in, one shock forces bad decisions. A job loss, a market dip, a life change, and suddenly you're selling assets at the worst possible time. 2. Over-optimization. You try to craft the perfect portfolio. You wait for the perfect entry point. The results? Years of compounding lost to hesitation. The cost of waiting is invisible until it is massive. 3. Over-concentration. You put too much into one thing you understand, like property or your employer's stock. If that one thing fails, your downside isn't 10%, it is everything. 4. The competence trap. You are elite in your career, so you assume you can outsmart the market. You take on risks you don't need, picking stocks, timing the bottom, or chasing yield, believing you have an edge. Often, the market humbles you. These mistakes don't happen because you know too little. They happen because you have consumed too much. Too much news, too much data, too much noise. Adding more information to a chaotic system doesn't create clarity. It just leads to 1 or 2 outcomes: total inaction or reckless hustle. That's why I'm not going to give you hot stock tips or top 3 platform lists today. You don't need more data. You need clarity, a structure to replace the chaos. You need simplicity, a pathway so you stop over-optimizing. And you need conviction, the data-backed trust to ignore the noise and act. That is what we're building now. So what does decision architecture actually look like? It's a system with the 4 building blocks. Security, what must not break. Flexibility, what options must stay open. Constraints, what rules can't I ignore. Freedom number, what is this building towards? Let me walk you through each one. Block 1, security. This is your defense layer across the different timelines. In the short term, no bad debt, 3 to 6 months of cash on hand, so market shocks don't force bad decisions. Medium term, sinking funds for irregular costs and proper insurance. Long term, don't neglect your pension so you don't wake up at your late 50s with nothing. I covered the mechanics of this in my high income, low security video. But know this, without security, every decision feels urgent. With it, you can think clearly. The block ensures nothing breaks, so everything else can work. That's the foundation. Block 2, flexibility. Flexibility answers a specific question: how do I buy myself options before I reach financial freedom? This is where many high earners get stuck, not because you're indecisive, but because you're trying to preserve choice without structure. Once your security is covered, money stops having an obvious job. You aren't saving for disaster anymore, but you aren't freer. So the cash just sits there. Flexibility lives in that middle ground. I call it optionality capital. It buys you the time to change careers, the capacity to reduce hours. It funds sabbaticals, a passion project, or starting a new business. And if you want to retire early, this is your bridge fund before you can access your pension. Here is the mistake. Most people treat flexibility as open-ended. So they hoard cash, not because that's the most efficient way, but because it avoids commitment. The problem is, without the boundary, flexibility becomes permanent waiting. This is where your freedom number matters. Once you define enough, you can define flexibility properly. You ask, how many years do I need to cover before my pension kicks in? What lifestyle am I protecting? What choices do I have to say yes to? That gives flexibility a specific size. And once it has a size, it needs a structure. This money can't be locked in a pension, but it shouldn't sit in cash for years either. It should stay reversible. And that's exactly what ISA is for, as a container for your flexibility. Accessible, tax efficient, designed for change. True flexibility isn't about avoiding decisions. It's about funding choice, deliberately, until freedom takes over. Block 3, constraints. Constraints answer what rules can't I ignore. Most people underestimate this, but constraints often dominate your outcome more than investment returns. Tax year deadlines, allowances that expire, thresholds at cliff edge. tax relief can give you 40 to 60% back instantly. That same return could take the market 5 to 10 years to deliver, depending on the cycle you enter. Timing matters here. Missing a structural advantage can cost you tens of thousands. Once you know your security is solid and your flexibility is preserved, the constraint block becomes simple. For most UK high earners, the tax-efficient pathway usually looks like this. Emergency fund, cash outside any tax wrapper in a high-interest savings account, pension match, free money from your employer. ISA, funding flexibility up to the £20,000 allowance. Pension for long-term freedom using higher rate tax relief. General investment account, only once the tax wrappers are full. This isn't a rigid rule, it's directional logic. The order matters because tax wrappers decide how much of your compounding you actually keep. Block 4, your freedom number. Now, here's the block that changes everything. The freedom number answers, what is this building towards? This is your North Star. Your freedom number is the amount of invested capital required for your living expenses to be sustainably covered without the paycheck. In plain English, it's the point at which work becomes optional. It doesn't mean early retirement necessarily. That's completely your choice. It just means if you stop adding new money, your system could still carry you forward. Once you know your freedom number, it changes how you see every decision. Because now you can price trade-offs in freedom units. Not abstract returns, but years of optionality. It turns money from something you react to into something you measure against the destination. And this is where the power shows up in real life. Let me show you what I mean. When we sold our first home, I had £40,000 set aside for a kitchen renovation. Architects engaged, quotes down. But I look at that £40,000 through the lens of my freedom number. At typical market returns, that £40,000 in my early 30s could compound into roughly £160,000 in my early 50s. Suddenly, the choice wasn't kitchen versus no kitchen. It was new kitchen versus a few years of freedom later. I kept the functional kitchen and invested the money, not as a sacrifice, but as a choice, because the trade-off between future freedom and current lifestyle gave me clarity. That wasn't the only decision. It was the first in a series. Security across timeframes, flexibility where I needed it, respecting constraints, all calibrated to one freedom number I could see. That is how I hit freedom layer 2. My pension and ISA are now compounding towards independence in the background. I still work to cover my living expenses, but the pressure shifted from accumulation to maintenance. I could slow down, have a baby, write a book, not because I had millions, but because I designed a system that gave me security and choice. You have the framework, you can make confident decisions, but usually people need the last nudge to move from knowing to doing. I recently heard from 2 readers who had been stuck in analysis paralysis for months. One had £70,000 sitting idle in her pension. She knew about index funds, but she couldn't pull the trigger. The other didn't want the money to take up her time, so she procrastinated any money decisions. What changed? Midway through chapter 11, the first reader stopped reading, logged into her pension, and invested the full £70,000. She told me, the charts on lump sum versus gradual investing were so clear, I didn't just understand them, I acted on them. The second reader took that same chart and used it to lead the conversation with her partner and convince him to change his strategy. That is a shift. They stopped asking, is this good enough? And started saying, I have the evidence to decide. If you have done the hard thinking but are still sitting on cash, look at the data. Historically, acting sooner rather than later has beaten waiting in 2/3 of the cases. You don't need more information. You just need to trust the evidence enough to click the button. So if you're sitting on a lump sum right now, here's the takeaway. You aren't bad with money. You don't need to become a day trader to manage this, and you certainly don't need to hand over control to a high-fee wealth manager just to feel safe. The barrier isn't your capability, it is your conviction. Once you have run your money through this framework, once you know your security is locked, your flexibility is founded, and your constraints are efficient, you have done the work. At that point, the plan is good enough. The data supports you. Trust the evidence, trust the structure, and act on the decision that is good enough. If you want the specific charts that helped my reader move that 70,000 pounds or the exact hierarchy for accounts I use, it is all detailed in my book, The Compound. It's the manual for high earners who want results without a second job. Grab a copy in the description below or download the free Freedom Number Guide to start calculating your enough today. I'll see you in the next video.